Chat Property. I'm here today with Manzoorul Khan, partner of Keshav Chartered Accountant.
How are we doing, Jeremy?
Scott LeCane, partner of Aussie Home Loans, Rouse Hill and Parramatta.
Hi Jeremy, lovely to be here.
And his lovely brother, Ross LeCane, partner of Aussie Home Loans, Parramatta and Rouse Hill. Welcome, gentlemen.
Great
Thank
to be here, Jezza.
We're going to be talking about a lot of the noise in the finance industry today, and I think it's a great topic for you guys both together to discuss. You know, with 40 years plus finance experience in this industry, you've seen a lot of things happening. A lot of things happen and what's going to happen, especially moving forward in the future. And Manzoorul, obviously you've been investing for a long time as well, so you've seen a lot of the ups and downs in the property market and the finance industry as well from an accounting perspective. So I'm very keen to hear a lot of your personal experiences as well as all your clients as well. But I think we'll get straight into it, gentlemen, and we'll get into, I suppose, the noise. What is this general market noise? What's happening?
Oh, there's lots of noise going on in the finance industry at the moment because finance is the key thing for property and the key thing for investors because it's all about affordability, and the ability to get finance is what drives affordability in the market. So if we look back in history in terms of seeing what has changed in the finance market, and these changes have been coming around for the last 4 to 5 years. So it's not new, since the APRA guidelines sort of came in December 2014. We've seen consistent change in the finance market across the different lenders in the way they assess someone's ability to borrow money.
And I suppose a lot of questions I get asked from people about APRA, and Scott, it might be good for you to discuss it. What is APRA? A lot of people who are just coming into the market looking to buy, they hear things about APRA. Who are APRA and what are they actually doing?
Yeah, look, I don't think people should get too consumed, but APRA are the regulator. They're making the rules in terms of how the banking sector works, and want to run the race in terms of they want people to play within their rules basically. So they've had a look at how people have been lending, and they've tried to tighten it up. Effectively, things like living expenses, how banks are servicing debts. That's what we've seen change over the last 4 or 5 years. In terms of like living expenses, we used to run on the HEMS, which is the household expense measure, which is what the ABS use. So Australian Bureau of Statistics would say, all right, for a couple with 2 children, you need X amount of money to live a month. And lenders have generally been happy with that. The changes that we've seen over the last few years that we're really seeing come to the fore right now is actual living expenses being used for servicing rather than this HEM measure. So, I mean, APRA is really just the regulator that have tightened up the lending rules on the banks and trying to enforce that. That is it. I don't think consumers should be too caught up in who APRA is, other than to know that they're the regulator wielding the stick, trying to keep the banks in line.
Beautiful. And I suppose, Ross, coming back to that noise in the market, let's really go back and understand the true fundamentals of where it was to where it is today. Can you give us a little bit of a timeline and a little bit of understanding of, I suppose, what has changed? Why has lending become so much harder? And we are hearing it all throughout the media at the moment, how hard it is to get lending. Can you just share a little bit about that and I suppose your thoughts as well?
Yeah, definitely. So there's a number of factors that have changed over. One is the way the banks look at how they do their serviceability calculations. So there's now a benchmark where, across the banks, they need to assess someone's ability to borrow money and their repayments at a benchmark over the actual rate of interest they're paying. So that benchmark at the moment is set somewhere around about 7.25% principal and interest over a 25-year period. So going back, we had a number of lenders that would assess especially their existing loans on what the client's actual repayments was. So if someone had $1 million, for example, at 4.5%, the bank would assess them at $45,000 for the year. Now at 7.25% over 25 years, that assessment has doubled. So they need twice the income now to service that same amount of debt. So the banks are now assessing it at around $90,000 a year. So it's double. So you look at some of our clients that might have a $4 million property portfolio, that's 4 times 45,000. So that's an extra, $180,000 in net income they need to earn to be able to borrow the same amount of lending as what they